Well, welcome people here in person and all people online. We have 55 people online and 5 people here in person, so a great attendance. So it's my pleasure to introduce David. Thanks, David, for accepting the invite and coming to DTU to give the seminar. Thanks a lot. So a bit about David. David is a full professor in management science and machine learning in operations analytics departments of VU Amsterdam. Before joining VU, David was a full professor at TU Munich at TU. David received his PhD from University of Vienna in 2008 in business information systems and mathematics. David is very famous for his expertise in data-driven decision-making under uncertainty. And it's a long time that I'm following David's work. He's doing a lot of things on fundamental theories and also applications to different sectors, including energy, finance, supply chain, and logistics. Today, David will give a talk on trading strategies and algorithmic trading in continuous intraday power market, which is a very relevant, timely topics these days. So, David, the stage is yours, and yeah.
Thank you very much for the invitation and also for the very kind introduction. So, this talk today, I want to basically talk about short-term trading in electricity, and in particular focus on the intraday markets. Okay. And I decided to not make this a deep dive into a single paper or 2 papers, but rather give you a little broader overview of what I myself have learned studying this topic in the last 3 to 4 years. So you will not see too many formulas. I will not go into the details. I would rather try to give you a couple of takeaways that I think are relevant. And this is the reason why I also have a couple of co-authors here. I will not go through them here in details, but these are all the people that contributed to what I will talk about today. I also want to apologize already. So I'm talking mainly, I joined the VU at Amsterdam 1 year back. So till then I had a very German perspective, which is probably not what you, it's different from what you have here in Denmark. So many of the things will not like be one-to-one translatable, but yeah, I think the markets in Europe are converging anyways, so I think it will be a sufficient overlap to be interesting. Okay, so here's a very simple structure of the talk. I will start by giving a little bit of a background and a context in electricity markets. I think most of you will know most of the things that I will be saying, but nevertheless, it's good to kind of define a few terms, get a common language. After that, I will talk about multi-market bidding, focusing on electricity storage, so the problem of having several markets and trying to decide how much capacity to allocate to which of those. And this will hopefully motivate the third topic, which is, I think, the most, that I will dedicate most of the time, which is on intraday trading, okay? And I have 2 things to discuss here. One is weather-based arbitrage. Okay, so this is a purely without assets arbitrage trading, and the other one is high-frequency intraday trading for battery storages. Okay, so let's dive into the first kind of introductory section. So obviously, we come in the energy sector from a very kind of simple design. This was like 20, 30 years ago. We had like vertically integrated utilities that dealt with basically all aspects of energy, or in particular electricity, generation, transmission, distribution. So since then, we have come a long way and things got more complicated. And again, that's the German situation. But I think what I want to convey here is that we have liberalized the fundamental mechanism of information transitions are now prices and markets. And we have a lot of those markets. Okay, and basically keep introducing more and more markets. Every problem calls for a new market in some sense, as we also talked about at lunch. And Of course, the issue with that is that there are complex interdependencies. Trading is often decentralized, so without any awareness of the physical grid. And we need a lot of kind of repair mechanisms. So these are basically, in the German design, these blue boxes are all like kind of balancing or markets which generate a physically feasible solution. And additionally, we have quite high entry barriers so that we cannot really bank on intra-market arbitrage. So we actually have to consider all of these markets if you want to make good decisions, at least in theory. Okay, so that means if you have an asset, generation or storage or demand response, you would invariably ask yourself the question, where should you trade? Which of these markets gives you opportunities to earn money, and how should you trade? Okay, and that will be kind of the theme of this talk. Okay, so that the goal is we want to have trading strategies on short-term markets which are non-anticipative. Means that we don't want to assume that we know the future, but we want to trade only on the information that we have at the moment that we make the decision. Okay. Furthermore, I will focus on European market design. Okay. No long-term futures, so we really focus on short-term markets. Furthermore, I view these problems, and that's probably due to my history and training, as decisions under uncertainty, in particular price uncertainty, but of course also other things like generation volumes, demands are uncertain, or inflows in hydro plants, things like that. And in all of what I will be saying, and that's maybe different to some of your work, I'll take the perspective of a single player. Okay, so we'll not talk about market equilibria or market design or things like that, but single players that maximize their profits. Furthermore, I will assume that these players are not strategic. They don't try to game the market or exhibit any market power, but at the same time, and that's a little bit of a tension, of course, they have to, as I will argue, recognize that markets are not efficient. Okay, I'll say something about that in a minute. So that's kind of the broad picture of what I want to talk about. So what are the challenges in this context? So first of all, we have a lot of randomness, short-term fluctuations. We have typically complex technical constraints. Okay, so think about unit commitment problems or modeling of batteries, all of these things that make your problems non-convex when you think of them as optimization problems. We have at the same time typically a high temporal resolution of the decisions. So we want to trade, I don't know, like quarter-hourly product, hourly product, things like that. But very often also longer time horizons to plan. At least for some assets, some seasonalities matter. Okay, so that's not a good position to be in. Short time intervals, long planning horizons. That's basically many stages if you translate it into the language of optimization. And we have illiquid markets. Okay, so that leaves you with a high-dimensional, complex decision problem under uncertainty, typically. So I didn't talk about any specific problem yet, but that generally is how I view these problems. Okay. Okay, and let me talk a little bit about this liquidity issue, because this will keep coming up in the talk. So I'll talk about the intraday market in particular a lot, and their liquidity is an issue. So if you contrast that to the second part of the spot market, the day-ahead market, and you see that there is a market difference. So in the day-ahead market, the day-ahead market is characterized by high volumes. As you see here on the graphs, we have much higher day-ahead volumes than we have intraday volumes. So again, that's a German situation, but since it's uniformly like that across Europe. And we have an auction, a single auction. So all demand and supply is kind of matched in one auction. Okay, so you have quite good liquidity. You have to be really big to make an impact in this market or change prices. The intraday market is very different. So first of all, it's much smaller. It's growing quite a bit, as you see here over the last years. but it's much smaller nevertheless. And additionally, we now in Europe have a system of continuous trading. Okay, that means these volumes might not be so small any longer, but they are spread out a lot. Okay, so you trade basically the whole day, you can trade some contracts. So I can now trade the contract for, I don't know, 10 in the evening, and I can keep doing that till 5 minutes before delivery. So that means that at any point in time, there might actually be very little liquidity in this market. Okay, so that makes you actually make an impact if you trade even small quantities. And this is illustrated in this graph here. So here you see a financial asset. It's a large asset. It's an Amazon share, and the bid and asks for this Amazon share. And you see that there is basically no bid and ask spread. Whereas here, this is a product an hourly product on the EPEX, and you see bid and asks are quite far apart. There's a huge bid-ask spread, and this only gets better a little before gate closure. And if you look closely, it's still not great. Okay, so if you have a liquidity issue, you can try to quantify that. I did this with a PhD student of mine. Try to bring this into the, if you have an issue with liquidity, you can think about it as a cost. If you trade, this incurs liquidity cost, and we proposed a measure, weighted cost of round trip to measure this, and you see that basically for trading 1 megawatt hour on the German intraday market, you pay anywhere between 2 and 4 euros in liquidity cost, which is substantial, or at least substantial enough that you have to somehow, if you think about optimal trading strategies, you have to somehow take this into account. Okay. Okay, so that's my take on liquidity. So let's just talk a little bit about multi-market bidding. Okay, so I will later on focus on the intraday market, but in principle, what you want, if you have an asset, ideally, so the holy grail of all of this would be you consider all of the markets in combination, and you have a huge optimization algorithm which will tell you where to place which orders. So this is completely out of reach. So I will focus on a little simpler problem, and I will look at the day ahead and the intraday market only. Okay, so these are, I will kind of not focus so much on any ancillary service balancing, things like that, but just day ahead and intraday. And the setting that we studied in this paper is basically a storage which trades on these two markets. And what we ask is 3 questions. First, the first 2 questions basically are, do we at all need both of these markets? Isn't it enough to just trade on the day ahead market? Why bother with the intraday market? Or vice versa, if I have the intraday market, why would I at all bid on the day ahead market? Okay. And then if you actually need both, you could still ask the question, if I have to trade on both, can't I just decouple that? Can't I just first trade on the day ahead market? Okay, because this decision comes first. Commit all my capacity there. And then when the intraday market opens, I could still see if I can make a little bit more money on the intraday market. Okay, so that's what I would call separate planning. I separately plan for both of these markets. So can I do that? And if so, how much do I lose? And what we did in this paper is we approached these questions from 2 sides. The first one is a analytical model, okay, a very stylized model, okay, which we can solve but analytically. That's the nice thing about it. And what we can show here is, roughly speaking, so that's the main result. If prices are martingales, okay, intraday price, so the day-ahead market is fully liquid, there is no price response, and in the intraday market there is a linear price response. That means if you trade, if you sell power, you're making the price lower. If you buy power, you're making it higher in a linear fashion, linear in the quantity. And if the intraday market has a higher dispersion, okay, the prices. If that all is true, then you can show that it's never optimal to use all of your capacity in the day-ahead market. Okay, so this already answers the first question. You should always reserve something for the intraday market. However, if the price response is small enough, so this beta, the slope of this price response function, then it can be optimal to only trade on the intraday market. Okay, and if you look at the kind of the mechanics of these proofs and how this all works out, you see that somewhat unsurprisingly, the intraday market is attractive because of the high volatility. So we're talking about a storage. A storage wants high volatility. It wants to see different prices to make money. And there are some information advantages also. And the attractiveness of the day-ahead market is market depth. That means from this kind of very simple analysis, you can already take away if you have a very small asset, okay, which is kind of very flexible, like a small storage, small and fast storage, the intraday market is probably where you should go. And if you have a very large asset, the day-ahead market will play a lot of role for you. Okay, so that's kind of takeaways from this simple model. What we did then is we tried to quantify that. And because that was a very stylized setting, so we set up a large kind of stochastic programming study where we tried to numerically study that. And so basically what we did is we said, okay, we are trading on the German market. We have three types of assets: a small battery, a quite large but not so uncommon pumped hydro storage in Germany, which has a pump, obviously, as the name suggests, and a seasonal hydro storage, which does not have a pump, but it has an inflow. Okay, so that you just find this in the mountainous areas. And then we looked at 1 day of trading only, day ahead, and then intraday. And in intraday, we have we look at the full time of intraday trading, so up 32 stages, or 33, sorry, stages of intraday trading. Once every hour, we trade on the intraday market. So we rebalance once every hour, trade all the products that are still tradable, and try to maximize the revenue of operating these three storages. What is random? Basically, the prices and yeah. Okay, so that results in a quite large stochastic optimization problem. We spent most of the paper trying to find ways of dealing with that complexity and so on. I will not go into that here. What we ended up with, or what is interesting for this talk, sorry, maybe I should first say we had these three strategies. So we have basically our stochastic optimization, okay, which is a coordinated strategy. So it takes day-ahead bidding and all these intraday stages in one big problem. So it reserves on the day-ahead market already capacity for the intraday market, anticipating what will happen there. That's one strategy. Then we have sequential bidding, which doesn't do that, which just bids on both of these markets, but it bids on the day-ahead market just as if the day-ahead market would be the only market, just unaware of the prices that would realize, but otherwise not anticipating an intraday market. And then afterwards, doing the same thing on intraday market. So every hour, just trade once. And then we have intraday only. So just the same thing, just without the day-ahead market. And basically what we found, so this is a big table, many numbers, you just focus on these numbers which are in red or circled in red. So what we found is that the gains of coordination are on average 7% over all the cases, all the three assets. We have also two types of days, summer, winter, and they vary a lot, okay, between the assets. What you see if you look at here the pumped hydro is that the pumped hydro gains most from this coordination. Okay, so if you don't solve this in a coordinated way for the pumped hydro, it's in some sense the most difficult asset because there's a lot of flexibility. So it's good for the intraday market in some sense, but it's also very big. So you cannot only rely on the intraday market. So you actually need this coordination. And the two others, the reservoir without a pump and the battery, they gain much less from coordination. And they are but different still because the reservoir, in principle, if you look at the day-ahead revenues of the reservoir, you see that the reservoir could basically live very well with only day-ahead bidding. So for the reservoir, the day-ahead is actually the relevant market, and intraday is just a little bit an icing on the cake. And for the battery, it's exactly opposite. Okay, for the battery, you see here that most of the, so if you look at the intraday only strategy here, it's not so much different than if you do the coordinated bidding strategy. So that means if you only trade on the intraday market for the battery, that's not such a bad outcome or solution. Okay, and that motivates, hopefully, now the transition to just looking at intraday only trading. So what happens if you only trade on the intraday market? But so here what we did is we had 33 stages intraday market trading, which means that we rebalance 33 times, but the intraday market is a continuous market. So we could have done this not 33 times, but 100 times or 1,000 times. And so what the ambition now in this last part is to look into what happens if you trade on this continuous market, really taking advantage of this continuous nature of it. So really trading like tick by tick, okay? Okay, so let me just say 1 or 2 words about how this works, how the intraday market works at all. Okay, so we have in Europe, we have basically the European Commission decided on this continuous intraday market design, and there is a convergence to that in the whole Europe. We have XBIT and so on. So that's very similar to how shares are traded. Okay, so what you have is you have offers, so people who want to sell electricity, they submit limit orders, so they give a price and a quantity that they're willing to sell, and that there are bids, that these are the people who want to buy. They also give limit orders, quantities and prices, and of course there are a little bit more complications. There are some order qualifiers which just disregard all of this. Okay, so that's basically the state of this market for one product. So for every product you have such an order book, every product that is traded, so every hourly or quarter hourly or half hourly product. And then when a new order comes in, okay, so suppose we are here and then somebody places an order and says, I want to buy and I'm ready to pay 50 euros per megawatt and I want to buy 29 megawatts. So what happens? 50 is larger than these 2 orders. So there are some people who want to sell for prices lower than 50. And this order for 50 is cleared against these 2 prices. And one of these orders is just partially fulfilled. This remains in the order book, okay, with the residual quantity. So that's how this works. You don't really see these distinct stages here. So this is everything in this box is instantaneous. Okay, it's not visible to market participants. It's in the clearing server, if you will. And this happens at a pace of a millisecond. So milliseconds are is how this market works. So millisecond per millisecond. And we have a whole lot of orders, not as much as in the financial markets, but this grew in the last 5 years tenfold. So 2017, we had 24 million orders, and 2021, we had 240 million orders. So this is like quite a lot to process. And what I want to try now is have some strategies that actually go into this order book level data and really try to trade on these fast time scales. Okay, so the first thing to realize is that any classical stochastic programming or any type of optimization really is just hopelessly too slow for that. Okay. So we'll see that also, but we will not be able to do any scenario trees or anything like this. This is just, it's just too fast, this market. So we have to come up with some heuristics, okay? And this is basically my two attempts of coming up with such heuristics. The first one is quite interesting, I think. It's basically arbitrage trading, okay? So we talked at lunch, what are we doing for society? I don't know if you're doing anything useful, if you're doing arbitrage trading, but just as an academic exercise, let's just see what happens. So what we want is a arbitrage trading strategy, which what arbitrage means, it's not quite true from a mathematical finance point of view. It's not real arbitrage, like positive profits out of nothing with probability 1. It's not that, it's more statistical arbitrage. So basically what we want is we have no assets. We have no production, demand, or anything that we are managing. We are purely financial, and we're trying to trade based on weather forecasts. Okay, this is our information. This is our signal that we want to trade on. And the idea is we optimize some trading strategy, which has some parameters. You can think of this as reinforcement learning if you want. And we want a policy which is which is basically can be applied to order level data, which is reasonably fast so that we can actually react to whatever changes we see in the order books, and which should have positive out of sample profits on average, okay, over a longer period of time. Okay, and this is basically, you can find this in this paper. And the idea here is, and this is kind of borrowed from algorithmic trading in finance, is you just want to be the first to react to a signal. You want to be fast, okay? So you have this order stack here, and you need to say you have a fundamental value. Okay, this is, you can think of that as, of course, a fictitious thing, but like the true value of an asset, the true value of power at that point in time. So it's 36. Then some information arrives, okay? Suppose weather forecast changes. We're terribly wrong about the wind power forecasts, okay? It's much less than we thought, okay? Suddenly, the fundamental value goes up, okay, in the intraday market. So all the people that sold wind power, they have to buy now to honor their commitments. So fundamental value goes up to, say, 75. So if you are the first to notice that, then these two guys, they have some quotes in the market which they would want to retract, actually, if they had enough time, okay? But if you are the first, and if you are quick, you can actually snipe these stale quotes, as they say, okay? So you can actually accept these two, buy them cheap, so to say, and resell them later on for a profit. Okay, so that's the whole idea. It's trivial in some sense, but there are whole industries in finance that do that. So the New York, Chicago arbitrage, you can read the whole papers written on that, okay? And we try to see, does this work in the electricity market? So what are our signals? I said it already, it's basically forecasts of renewable production. Okay, and the rationale is, I think they don't have to say anything here at the wind power department, but of course we have a significant fraction of renewable energy. Typically, renewable producers, they bid on the day-ahead market based on day-ahead forecasts of their production. And of course, if there are errors in these forecasts, then this triggers demand and supply shocks. Okay, and this is very well documented that it's also quite obvious. Okay, so the strategy is that we get weather forecasts or updates of weather forecasts early on. Okay, and look at the difference between the day-ahead forecast and this updated forecast, and then trade accordingly. Okay, and this is basically a picture which should tell you how the strategy works. So basically what we define is two time windows. Okay, this first time window, we build up our position. Okay, we say here at T1, we get a forecast for the delivery T as time periods before delivery. Okay, so this is our signal. This is the difference between the day-ahead prediction and the prediction, the new prediction. Okay, this we'll get here at the beginning of this time interval. Then we know what we want to do, buy or sell. Then we have this amount of time to build up our position to buy or sell. Okay, then we have a waiting or holding period. And then there's a second time interval where we want to unwind our position. We want to sell back or buy back or whatever. And hopefully for a profit. Okay. So and the strategy now works like this. You have basically four you have the time intervals and these four parameters. So this is a delta plus, delta minus. This is a signal strength. So you only want to act on a signal if it has a certain strength. Okay. Otherwise it's too weak. It probably won't change any prices. And then you have the quantities that you actually want to buy or sell on the market. Okay, these are four parameters of this policy. And you can imagine you can somewhat train these four parameters in such a way that in sample they work well, and then you can, I don't know, do all the things that you usually do, cross-validation and whatnot, so to find good parameters. Okay? And if you do that, okay, yeah, so we did that, I should say, and we tested it on order level data for Germany of the year 2018. So we just run this for 1 year and see where we land, okay, with the best possible parameters. We take 180 days always to train in a rolling fashion. Then we trade for a day. We roll the window of training data, again train for 180 days and so on. And we take two types of forecasts. One is the 8-hour before gate closure forecast. Okay, so this is our update of the day ahead forecast. And one, we take the true production of renewables. So this is a forecast that we don't really have, but what it gives us is the value that we get if you use that. It gives us the potential of a completely accurate forecast. And then we just, we kind of devise a patient trading strategy, which is based on limit order placement and so on, to avoid the adverse effect of illiquidity. Okay, you have to think a little bit about that. I don't have the time to really talk about that. We try to make this as realistic as possible. So we pay the trading fees. We see that the order to trade ratio doesn't violate EPEX limits and so on and so forth. And we kind of accurately evaluate this strategy based on 44 million orders for hourly products and 131 million orders for quarter hourly products. Okay. So here's kind of the outcome of that experiment. So what you see here is, first of all, the positions that are taken here. Okay, so you see these are sometimes quite extreme, up to 200 megawatts buy or sell. So these are our parameters, this V plus and V minus, how much we trade. Here you see the values. These are not that high, like in the order of 10 to 20,000 euros. And here you see the cumulative profit over a year. And you see that this over a year, you earn something like 200,000 euros with the 8-hour ahead forecast. However, of course, you don't earn any, it's like, on some days you also lose. Yeah, so it's not foolproof or anything, but like over a longer period of time, you can apparently expect to earn something. We also have statistical tests of significance of that and so on. It's not a fluke. And what is also interesting is if you had this perfect forecast, this is the red line, you would earn 10 times more. So this is another axis on the right side. So instead of 200,000, you would earn 2 million. Okay, so that's basically, you could say, that is the willingness to pay for a perfect weather forecast, 1.8 million for a year. Or that's the kind of potential that you could reap from that. Okay. And you also see that we don't have to go to the balancing market very often, so just in a couple of hours, actually, less than 10. Okay. How large is the volume? So it's like 200 plus minus 200 megawatts. So that's actually quite substantial for the intraday market. And of course, you could ask the follow-up question: how many of such arbitrage traders can a market sustain? Not many, but yeah, maybe that's for the discussion. Okay, so I think I'm running a little bit out of time. So the last topic is something which is a work in progress. Okay, so I just have some preliminary results on this. This is basically optimal trading decisions for a battery. Okay, so now it's not arbitrage trading in the sense that we don't have any asset, but we have a battery. Okay, so if we optimize a battery, what we ideally want, so if we had some kind of a magical solver, yeah, which would solve difficult problems for us, we would try to solve this problem. So what we would have is we would have a number of products. This is this script T that we trade. We want to maximize our trading profit here. This is this first sum in the objective. We have some degradation cost, and we have a future value of our position. So we have to somehow trade our immediate profits or trade off our immediate profits with what the future value of our position is. Okay, so that's stochastic programming or a dynamic programming formulation of that problem. And then we have some kind of bookkeeping constraints in our financial position F and in our storage position X, which also has this kind of efficiency, which could also is an efficiency function. So how does the energy that I take or give to the grid translate to a state of charge? So that's a very hard problem to solve, and we have to, in principle, solve it very often. So that's not good. So why is it hard? First of all, we have to, in order to get this pi right, we have to look at the whole order book. Okay, it's not just a linear price, it's not price times quantity, but we have to look at the order book. We have two non-convexities, battery degradation costs, efficiency of charging and discharging. And of course, we have this expected value function, which per se we have no idea how to get. Okay, so in principle, these are the complications. And of course, if you want to have any sensible strategy, you have a trade-off. So either you make this problem complicated and you trade very infrequently, or you kind of assume a lot of complexity and therefore you trade very frequently. And this latter thing is what we want to do here. Okay, a simple strategy, but therefore we want to trade a lot, very often. Okay, and this simple strategy is called the intrinsic value. Okay, the intrinsic value of a storage, intrinsic value comes from option pricing theory, is basically the myopic policy. You just remove the V, this value function, forget about it. Okay, we're just concerned about our immediate profit. So that makes it greedy or myopic and therefore suboptimal. And then we do this in a rolling fashion. So we just solve this so we solve it, then we observe a new state of the order book, we solve it again, maybe rebalance and so on. We do that. It's called rolling intrinsic. It comes from gas storage valuation, where it's a kind of a near optimal policy. Okay, so what we want to do here is we want to model the revenue pie accurately. We want to react instantaneously to changes in the limit order book, and we linearly approximate these nonlinearities, okay, because otherwise we couldn't do that. But even if we do that and we reduce the problem to a LP or mixed integer linear program, we take roughly a second to solve one of these intrinsics. But that's too long. Okay, so if you want to do backtesting, you have 240 million orders, you take a second per order, that's not good. Okay.
Why is it milk?
Yeah, why is it milk? The milk part is not the big problem. So if you have negative prices and you have non-100%, you don't have 100% efficiency, what the LP does is it charges and discharges at the same time. So you make money by burning energy, but that's not physically possible with the battery. So you have to have one binary variable per product, which is not a big problem. It's not difficult. It's not difficult. But still, it takes a second, roughly. I mean, okay, that's like an estimation. You can do a little bit. Sometimes it takes a little longer, sometimes it takes a little shorter, and so on. Okay, so, but 1 second is already too much. Okay, we have a millisecond market. We want to backtest all of these things. So we have to be significantly faster. So what I propose here is a DP formulation, a dynamic programming formulation of this problem, where we say each product, so suppose you have many hours, each product is a stage. Okay, in principle, I can trade all of these hours at the same time, but we say each product is a stage, and I discretize my action space, so how much I trade, and then I carry over the storage state as if this would go into delivery. Okay, and I have a state which is just my state of charge. And the advantage of that is, so first of all, it's much faster, so it's 10,000 times faster, roughly, and enables this backtesting, what we want to do, and also quick, so we can actually react on a millisecond time scale. And we also have automatically feasible decisions. So in principle, the LP gives you fractional decisions. You can only trade in 100 kilowatt blocks, so that's a little bit of a nuisance. Of course, you can round and so on, but in principle, that is gone if you discretize your state space, or your actions, I should say. And you also don't have this milk problem. You don't have this charge and discharge, this just vanishes. Okay, so these are two good things. And just at the end, I just want to show you two preliminary results. The first one is, so we have a case like 2021, 1 year backtesting. We look just at the hourly products at the intraday market, no quarter or half hourly products, German market again. We have a battery, 10 megawatt hours, 10 megawatt. So duration of 1 hour, 95% efficiency, and 5 euro degradation cost, okay, per cycle. So the question is, what do we earn if we trade at every order book update? So this is the blue line, every 15 minutes, this is the orange line, or every hour. And the first thing that you immediately see, of course, if you trade, not of course, but if you trade more often, you earn more. Okay, so it pays, speed pays. Okay, that's one thing. And if you look at the volumes, you see that the volumes are also much larger if you trade more often. But the cycled volume, so that's the actual energy that you cycle, is not much larger. Okay, so you just have many financial trades, back and forth trades, if you trade more frequently, and this gives you a higher profit. I should also point out that you have a lot of cycles with this strategy. Okay, so you have 1,200 cycles in the worst case. So this is a lot. So people usually say 1 cycle a day. If you look in the warranty of your battery, that's 1,200 is a lot for a year. Okay. Okay, but it still, I mean, we are paying the degradation costs in some sense. Maybe they're a little on the low side, but like anticipating what prices would be in 5 years, It's not too unrealistic. Okay, the second thing is what David Schaurecke, the student that I'm doing this with, is very interested in is the value of forecasts. So what happens if you have a forecast for a price? Many people do price forecasting in the intraday market. What is the value of that actually if you use it? So if you have a price forecast, you can make this myopic rolling intrinsic, you can make it see the future a little bit. So you can allow it to trade instead of against the limit order book, against the forecast. Okay, so that means you can leave a position open. I can buy now and sell in the evening, but I don't sell against the limit order books doing actual transactions, but I sell the forecast, believing that I will at some point get to that price. Okay, so I have a half open position, so I have only one leg of such a transaction. Okay, so if I do that, and I have a perfect forecast, so this is the red line, you earn double. Okay, that's not so surprising. If I know what the prices will be, I can earn a lot of money. If I have, and this is a little bit more realistic, a forecast with 15% standard error, okay, with an additive noise, I still get significantly more than without no forecast. And somewhat surprisingly, if I take the intraday auction prices in Germany as a forecast, I actually do worse than if I have no forecast. So the intraday auction is like a day ahead auction. It's still on the previous day. It's like for quarter, basically again the day ahead auction, but just for quarter hourly products. Okay. So that means, yeah, there is a lot of scope for good forecasts. Okay, and we are planning to test this a little bit more realistically with actual forecasts. And with a problem with all of that, to end on a negative note, is if people who have a battery usually don't trade on the intraday market. So that's not what they bought the battery for. What they bought the battery for, if they didn't buy it for something else, is a primary reserve. Okay, that's what most people do. It's much easier, and it turns out it's also more profitable still. Okay, so that's a little bit, but the FCR market is small. Okay, so it's 800 megawatts in Germany. That's not a lot. So if there are a couple of batteries, prices will fall. Okay, and that brings me to my conclusions. Yeah, for the sake of time, I will not talk too long here. Intraday market is of increasing importance. These trading problems are hard, and a good strategy, I think, takes into account relevant information. So this is in particular weather, but it's also liquidity, and if you have any good price forecasts, of course, price forecasts. And it is important to trade quickly, okay? So that you be able to execute this, train and execute this trading strategy in, say, at a millisecond time scale. Okay, that concludes my talk. I think we have a little bit more time for questions.
Yeah, very good. We have 79 people online.
Oh.
I already have 4 or 5 questions. For people online, I'll be very grateful that you write your questions in the chat box. We are recording the video, and since the sound might not be clear, so that would be great if you write your questions. So I will read the questions. So let's first start with people here. Do we have any question here? Ben?
Do you think it's feasible to combine FCR and intraday trading?
Yes. So so in principle, if you look at that, so I showed you this graph where FCR is better than intraday. So I also work on a project which I didn't have the time to discuss. This is true. FCR is better than intraday, but not always. So you can identify periods. So in Germany, you have these 6 IFA blocks, 4-hour blocks, and there are features which allow you to identify periods where it is probably more beneficial to not trade on the FCR market, but at least reserve part of your capacity in the for the intraday market. So there is we have a paper on that, and
do we know why do we have this kind of trends that you're saying? Sometimes FCR, sometimes. Is there some reason?
Is there some reason? Let me think. There seem to be just some some of these blocks where there's just the FCR price is just low, and at the same time you have a lot of intraday volatility. I cannot quite now reconstruct if we have identified any feature combinations which give a good explanation of that pattern. But yeah, no, I don't have a good answer to that.
Good. So let me go to online. So the first question is from Bernardo Panzelli. Hopefully I'm pronouncing his name correctly. From Schema Business School, and he's asking, can the players become companies that do not own any energy assets?
Yeah, so that is the case of this arbitrage trading. So that's basically, if you don't have an asset, you have to. I mean, maybe there's another way, but in principle, you have to trade on information, and that's what we tried here. So to just have information on weather, for example. I think weather is probably the most relevant, but could also be demand or demand shocks or something like that. And in principle, that's possible. So it's possible to be on the intraday market and just be a financial player. You just have to always clear your position before gate closure. And that's what we do here. And of course, profits are moderate. And I think there is also only a limited amount of profit that you can make, like in any of these arbitrage trading strategies. And this is why, of course, only the quickest or the most competent traders would be able to reap these benefits. But in principle, yes. So that was the idea here.
Bernardo, if you have any follow-up question, please feel free to write. Andrei Churkin from Imperial College. I think it was slide number 10 that he was saying, can you explain where the number 33 comes from?
10, 33.
There's no 33, Andrei, here in this slide.
33. Maybe the next one, or this one, maybe, or no?
Andrei, are you hearing? Okay. We can see later. Okay, let me move to the next question by Eric Learson from Kipa. When trading battery storage with limit orders, how do you make sure you are still able to physically deliver your positions together with the uncertainty of an order being cleared?
Okay, so that's a great question, actually. So what we assume is that because we are like sub-millisecond with our decisions, that we see the order book in a certain state, and we decide on certain orders that we want to accept. We actually, I mean, there's much to say about that, but so we are actually just clicking orders. So we're seeing orders and saying, accepting this and this order. So I'm buying here, I'm selling here, or something like that. And we assume that we're always getting these. So we are not ending up with just one leg of this transaction and then having an imbalance. Because of speed, of course, that's not completely, as you would have to also include something like ping time to the clearing server or something like this. And then there would be some instances where you don't get the orders that you want to get. So we don't consider that is the answer. But what we try to do is we actually, or what we plan to do is we actually try to put a delay between the decision and the when our orders arrive in the market, and then we can actually measure that. But we didn't do, as it is a preliminary results, but we will go in that direction.
Just follow-up question, but I'm asking that. So as you said, speed matters, and here you always assume that you are the one faster than others.
Exactly.
So all the results you have, it's kind of optimistic results, I would say, or oracle results.
Yeah, in that sense, yeah. So we assume that we are the fastest in that. We are the fastest, yeah. So that's what we assume, and yeah. So in that sense, it's optimistic, yeah. so we I think what we should be doing and what we want to do is we want to basically say, okay, make the decision, see the order book, make the decision, and then, just because of, I don't know, ping time to the server or whatever it is, just add 10 milliseconds, and then that trade arrives. And then if you don't get what you get, you just have to, in the rolling intrinsic, you have to just deal with a partially open position, which is in principle not a problem. But I don't have an answer how it would affect the results.
It's a hard answer. Hard question, I would say. I'm switching to in-person. Ben?
These 0.1 milliseconds, is this optimized for like parallelization and computing power and all this kind of things? Like how accurate is this to what a company would do compared to what you do?
Yeah, you cannot parallelize so well here because it's a sequential. So it's so we solve it as a dynamic program. So so basically it's a plain and simple dynamic programming algorithm. So you could parallelize a little bit in the backward path, so to say, of that. But I think this is so fast that any parallelization across different machines, so that the potential gain would just be eaten up by the synchronization costs. And then it's basically just about what, I don't know, how well you organize that, and maybe you could do a little bit better. So we have this in Java currently. I think we have a test implementation in C++, which is, I'm told, twice as fast, but I don't think you get an order of magnitude, but a little bit. Yeah.
Yeah, so is it correctly understood that the trading is more or less decoupled the physical assets, in the sense that only when it's closing, then things has to match? Because then the problem is similar to the share. I mean, you can have it faster, you ramp up the speed, and eventually you have this, what they call flash crashes.
Yeah.
And if they coincide with the closing, what happens then?
I'm not 100% sure if I understand the question. So you're saying that, so in this, the way we optimize this, also the last one in particular with the storage, we do not, also we always trade with the physical asset in mind. So the trades have to result in a physically feasible schedule. Okay, so we might unwind the trades later on, and we might buy something which does not go into delivery because we sell it back or something. But at every point in time, we just keep that. But I'm not sure if this answers your question at all.
But that's just you. But how about all the others? So the ensemble traders, it has to match a physical, let's say, 800 or 200 megawatt line. When you arrive at the close.
Yeah, exactly. So, so I mean, the easy answer to that is, or the cop-out answer to that is, so in Germany, you're obliged. I think you're still obliged to do that. So, if you're a financial trader, you have to close your position before gating. Of course, it can happen that it's not possible if the order book is empty or things like that. And of course, if you have assets, then it's a different story, because you can always, I think, make an argument that I didn't know that the demand was so high or something like this. Who could have known? But if you're a financial trader, I think I'm not sure how regulators would react if you kind of frequently have an open position at gate closure.
We have 7 questions online. I'd like to cover all of them, and there's one here, 8. So, we will not have more than 8 questions.
So I have time. I mean,
So Andre from Imperial clarified his question. It's 33 intervals that you discretized. So why?
Yeah. Okay. So that's hard. So because I'm not sure if you'd be able to exactly get it, but the idea is that the intraday market in Germany, although it's called intraday market, it opens on the previous day, and now don't trust me completely on that. I think 4 in the afternoon, or 3 or 4. I think the hourly products at 3, the quarterly products at 4, something like that. So it means you have a residual of the previous day where you can trade these 24 say hours of the next day on the intraday market, although it's the next day. And then you have the full 24 hours of the day that you're actually trading for, of course, only for the last product. So in the last stage of this trading, you will only trade the last hour and not and so if you then add up this 24 plus whatever it is, 8 or 9, you come to, and then you have a day ahead stage also. So you have a stage for day ahead bidding before the intraday market, and then you come to this 34, I guess. Or
good. The next question is from Fazlana Rahmati from DQN, who is now visiting Imperial. So she has questions about your dynamic programming formulation.
Yeah.
Could you please elaborate more on the dynamic programming formulation you used? How do you model and calculate the future rally?
So I was a little quick on that. So that's basically, this is, so you have time stages which correspond to the product. Suppose you have hourly products, you have 24 hours a day. You first trade the first product, And then, so to say, the value function, this future value, is the value of whatever storage state you end in after this first product goes into delivery in the last 23 hours. Okay, but it's a little bit confusing maybe because these are not really time stages. Okay, but these are just different products, and it's a little bit of a modeling trick. We just assume as if we would go through these 24 time stages. Of course, in reality, we are trading all of this at once. And so how do we get this? So that's plain vanilla dynamic programming. So we have a discrete action space, we have a discrete state space, we have finitely many, so it's a finite horizon. So how we get it in the end is just the dynamic programming algorithm. So we just get the value functions. We start at the last period for every possible state. We have a value there, and then we just go backwards. We get our value function, and then we go to make the decisions. We go forwards once again and see which products we trade.
I'll have one more online question and then I'll get back to you. So George Papazoglou from Aristotle University of Thessaloniki in Greece.
Yeah.
Asking, would the weather arbitrage strategy be any different when implemented for any other uncertainties like generator outage?
Sorry, say again.
Yeah. Would the weather arbitrage strategy be any different when implemented for any other uncertainties like generator outage?
So that means if you get a forecast, or if you're the first to learn about the generator outage and you trade, you could do that, obviously. How would the strategy differ for generator outages? I mean, I guess for generator outages, it is an event which affects you immediately. So you don't have this, like, you don't know like 8 hours before typically if there's a generator outage, unless it's a kind of semi-planned outage or something like this. But in principle, this type of thinking about this strategy is kind of independent of the signal that you get. So if you have a signal where you can reasonably believe that this changes the price, and you're the first to receive that signal and to react on it, you can do the same thing. So you can say, okay, I received this signal, I think it will get more expensive, for example, so we just quickly buy something. I wait till everybody else realizes that this is actually happening, the price rises, and I sell back. So I think the general form of the strategy would remain the same. Of course, you might want to adapt it a little bit to the exact case.
Okay.
Yeah.
I switch to one question here. So next, please.
Yeah, I'm Chun Yang.
Hi, I'm Chun Yang, working with PWX Group. I have a question about the battery cost. I think you put the constant value there.
Yeah.
And do you think it matters, like if it's a 5 euro per cycle, or it will be 10 or maybe 0.1? And
yeah, no, it matters. Clearly, it matters. Yeah, so clearly it matters. So if you have 10, you would probably earn less, obviously. I cannot tell you how much less. I think it would not be that, I wouldn't think it would be that dramatic so that it goes to zero or anything. I think another good question, which is, I think, embedded in your question is it a good idea to have it constant? Which is, of course, the answer is no, really, because it's a lot whether you do deep cycling or shallow cycling, I guess would be the opposite. But we are not able to, so with our speed restrictions, we are not able to or actually we might be able to do a little bit about it, but not, it would not be too easy.
Very good. Next question online. You have 4 more. Marco Galici, or Galici from Comillas, Madrid, Spain. He asked, have you tested the methodology when the battery is able to use complex orders like iceberg order, linked order, minimum income condition? Do you think you can reach completely different results?
Yes and no. I don't think that iceberg orders would help us a lot, because iceberg orders typically just kind of conceal that you have a lot of volume that you want to get rid of, and that's not typically the case with such a small battery. The other order qualifiers like immediate or cancel or fill or kill, I don't think that this would be a big game changer. I think what would be a big game changer, and we are also experimenting with that, is to instead of, so what we are doing now is we are looking at the orders that are there and we are saying, I take this and this order. So accept orders that are there. What you could do instead is you could say, instead of accepting, I could accept one order and I could put a limit order in myself for, say, the other leg of the transaction. So in the storage, you can always think of, you're always doing time swaps. You're always swapping hours. Okay, so if you do such a time swap, you could buy one immediately and you put one limit order in. And I think that would actually help a lot in not paying so much liquidity costs, because oftentimes you want to trade, say, you're at the beginning of the day, I don't know, 4 a.m, you want to buy something, it's cheap, and then you want to sell at 7 p.m. The problem is that the time that you can buy at 4 a.m, 7 p.m. is completely illiquid. Okay, so you will pay a huge penalty if you sell so far ahead in time. So if you were a little bit more patient and you could just put limit orders in, I think that would make a big difference. I think that's the thing that this really could make a big difference.
Very good. Arnie Hansen, he asked, was it correctly understood that the passive market order simulation was simulated against real observed volume?
The passive market. So what, I'm not quite sure if I 100% understand this. So what we did is we have the historical limit order book data of the EPEX for Germany. Okay. So that has, and we backtest using that. Okay. Yeah. So this has two problems at least. The first one being that Germany is not an island, so there are many orders cleared against in XBIT against other market areas, and we can only reconstruct them partially. Okay, so there's an error there. And the second thing is, of course, that we assume that we don't change the market. So if an actor comes in and trades like that, you could expect that, of course, certain orders would not be placed or certain additional orders would be placed or something like this. So this we cannot capture. But in principle, what we do is, and I think that's usually what is done in this, like also in algorithmic trading in finance, is we backtest against a historical limit order book, and we assume that this is what would have happened also if we would have traded in this market.
Great. Do you have any question here? Yeah. Yes. Here.
You mentioned at the beginning that the intraday market is increasing on a volume.
Mm-hmm.
Do you expect that this kind of arbitrage, high frequency trading, is going to be not that profitable as the volumes increase?
No, I think that I don't think so. I think that it will remain limited. So you will have a limited size of the cake to distribute amongst the people that do these types of things. But I think it will always be there. So, and I think if the market is bigger, this cake might even grow. So even in financial not even, but in financial markets, you also have that. So in the most liquid assets, in large stock exchanges, you have these strategies. You have people who, the famous example, I mentioned it before, observe a stock price in Chicago, and they know that Chicago is faster than New York, and then they transmit this signal to New York and they trade on this signal. And these are very liquid assets, these are very big exchanges, and you can make, if you're good at that, you can make millions with that. Of course, there is a limited amount that there's a limited amount of money that can be made by all of these people together, and those people who are fastest in that case, they just get the biggest share of this cake.
But I thought they had limited this now by implementing some damping in the system, so that you cannot do, because otherwise it was just machine against machine.
Yeah, exactly. And I don't know what the state is there, and I think there are different exchanges, and I think some exchanges did something, they made the ping time larger by some strange measures. And there are some people, some academics also, like for example, Crampton, who push very much against like limiting this. And I think one of the things that they propose is like frequent auctions. To say instead of continuous trading, we want like an auction, or many auctions, like one auction a second, for example, but not say sub-second. And as soon as you have that, all of this stops. So if you assume that people are competent enough to place an order within so in the sub-second range. So that's a large amount of people, and then people would not compete on crazy stuff like microwave towers to transmit.
We have 3 more questions online, and then I will conclude the
Yeah.
session. So Runyao Yu from TU Delft asked, assume you can predict intraday 1, ID 1. How do you calculate the profit? For example, your ID 1, intraday 1 prediction is 50 euro, while the order book has a bunch of raw prices like 40 euro, 30 euro, 51 euro. What is the rule of match them and calculate profit?
So in this exercise, we actually had the ID1. We have forecasts for ID1. And so what we do is we just keep an order open based on this ID1 forecast, but then we have to close it, or we have to do something on the actual order book. So we said we expect the price to be, I don't know, 50, say. Suppose that's accurate for ID1, but then ID1 is the average over all the prices that realized in the last hour of trading. So we have to then actually, in this last hour, or even before, we have to actually trade for a price that we see in the order book. So we don't assume that we get this 50, but we just use this as a signal to keep a position open, I would say. So basically to inform the intrinsic that prices might change in one direction, and then it basically say buy something in the hope of selling for that price. But when it actually sells, it has to sell for the price. It has to match orders that are actually in the limit order book.
Mohan Said Abdat, he didn't write the application. He asked, how do you determine the capacity that needs to be reserved during the day ahead, whether in the day ahead market or reserve markets, since both are cleared the previous day, to ensure it's available for use in the intraday continuous market, and that position is more profitable?
Yeah. So we didn't look at the balancing market at all here. So, but in this first part, I had this like multi-market bidding day ahead and intraday. And what is done there to reserve capacity is to have a stochastic program which does intraday, which places intraday bids, and then it has in the subsequent stage, day ahead bids, and in the subsequent stages, it has intraday trading. And so it basically, like in stochastic programming, if you solve this problem, it would anticipate a optimal intraday trading policy, and this would result in optimal day ahead bids, which then implicitly leave open a capacity. So if this results in the ahead bids which are not fully utilizing the capacity, then this makes this decision implicitly how much to trade on the day ahead market, and therefore how much to leave open for the intraday market.
Very good. The last question is from Mohsen from University of Pavia in Italy. How can the growth of local flexibility markets, where prices are much higher compared to FCR and intraday markets, influence the participation decision strategy, considering the unpredictability of flexibility demand from DSOs or PRPs? What strategies would be optimal for decision making?
Okay, that's a difficult question. I'm not quite sure. So the question was, if you have local flexibility markets where you have potentially higher prices
Than FCR.
Okay. How would that influence your decision? I mean, I'm not sure if I can give a very good answer to that, but of course, if you have access to another market which gives you potentially higher prices, then I would expect that you would trade there first. But I'm not sure if this really answers the question. But I think I don't have much more to offer on that, I fear.
Very good. I'm sure there will be more questions, but I encourage everyone to write directly to David.
Yeah.
Thank you so much, and let's thank David one more time.
Thank you.
And hereby I conclude the session. Thank you, everyone.
Thank you.